Hey folks, good evening. Welcome to another money space. Of course, with me, Kalu Aja. On this space, we're talking money, the economy, and of course, finance. So, welcome, guys. Um, this week we have a guest. I haven't seen him yet, but we're going to talk around the investment options, focusing on Nigeria, but maybe we can take it abroad as well. He's a very seasoned seasoned investor. You guys will know who he is once he comes online, Mr. Ebo. He's going to talk us around what are the investment options. I have four questions for him, really, and I think I share that on the space. It's going to be like a review of the 2025 investment climate. We're going to look at the 2026 investment climate. What are the opportunities out there and all that for investors? Then we want to talk around the tax law that has been passed and how it affects investments. Where should we look at? Where is exciting? Where should we go to? And then, of course, we want to ask him to give us his portfolio. I've tried to do two portfolios. If I'm a 30-year-old Nigerian, where should I invest? If I'm a 60-year-old Nigerian, where should I invest? Those are my four questions for him. He's not going to spend a lot of time with us, but let's see if we can get the best from him. Mr. Ayo, good day, sir. You're welcome. You want to kindly unmute and just introduce yourself, sir?
Okay. Good evening, Mr. Kalu. Good evening, everyone. It's great to be here. Thanks for all you do. My name is Dr. Ayodeji Ebo, and I'm an investment professional, so I'll be happy to share my experience on how we can better optimize our income as well as make good use of our savings for at least amidst the high inflation and taking advantage of investment opportunities. So it's always great to be here, and happy to also answer your questions. Thank you so much.
Thank you for being here, sir. So let's just get straight to it, right? Let's do a review of 2025. I saw the stock market did very well. What did fixed income? What did Bitcoin? Just give us an overview of 2025, if you can, sir.
Okay. Yes, I would say that 2025 was really an interesting year across different asset classes. So if I look at it, and if I look at even we start from the equities market, say for the market to return about 51.19% in 2025, which means that for those that we have what we call the ETF 30 that tracks the top 30 stocks that account for over 70 to 80% of market activity, liquidity, the like. So if you have invested and been a passive investor, minimum you have also gained close to about 50%, where you have inflation, whether it's the old method, new method at 15-20%. And when you look at the sector that actually performed well, so there's almost a trend that is establishing for those sectors that were impacted by FX in 2024, that had negative shareholders fund that recorded losses. Those stocks delivered over 100%.
Wow.
Consumer goods, for instance, delivered about 129.6%.
Wow.
You see the insurance sector on the back of the announcement of the recapitalization in 2025 delivered about 65%. The industrial goods, you look at the Boa Cement, Dangote Cement, delivered about 60%. And even banking, if you look at some of the top banks, say for Access Bank, on 1 year horizon, almost delivered close to about 60-70%. So it was really, we want to target like a super bull here for investors that were willing to take the risk. Why we know that the equities market has its own risk. But what I always say, if you invest in what you understand, if I don't need to tell you too much on how they make money, if you don't even want to know the ratios, the analysis, like Warren Buffett would say, invest in a business, there's no way you will hardly get it wrong. And even when market is down, if you understand, if you are bought higher when market is down, you should be more excited to buy at a discount. I would say buy at promo price. So that was really straight. When we also look at the fixed income, the first half of the year average yield from the shorter end of the curve to long was around 18-20%. It got to as high for treasury bills as high as 26% last year for primary in the primary market for 1 year. So you would see that even for the very conservative investor also still enjoy that yield, because money market funds started as high as 24-23%, maybe closed around 18%.
Wow.
For mutual funds. So that is also really very positive for fixed income. We saw the FGN savings bond on for some of the months was as high last year as 17-18%. For those that have locked in, currently is about 12-13%. So those that have locked in will still continue to enjoy that high rate for the next 2 years or 3 years.
Wow.
We also saw that was interesting. It was also a year of massive commercial papers. But I always put a caveat that always look at the rating. When companies issue commercial paper, see it like you are borrowing them money. So if you don't understand what they do, there's no point trying to, even if they are new names, try to read about it. Even don't rely on whether it's the investment house or the asset manager sending you the email. Ask questions if you don't know, because you are the one carrying the risk. If there's any default, it's on you. Yeah. So it's not on house, because you are the one that elected to go for that CP. So you have to, and that average, even on a net basis, return between 22 and 25% last year. So you see that overall, the market was really very positive for those that did not remain passive. I'm hopeful for some that maybe just leaving your money in a savings account, the maximum we could have received will be about 4%.
Wow.
Fixed deposits, if you don't have significant amount of money, maybe average of 10, for the tier 1 banks, if you get 10%, that would even be great, 10-15% if you don't have a billion. So there's a need, which I know we would also get into, is that you can't afford to be leaving idle funds on the table. You are not doing yourself any good by doing that. You must try, based on your investment appetite, objective, you must look for avenues where you earn return. As you are working your 8 to 5, your business, let something also be working for you. That's really very, very key. So overall, it's really an interesting year. So what we saw that through the spanner around the wheel towards the end of the year was the tax reforms, the CGT, which I know, like you mentioned, we'll still go into. So we saw that sell-off in the equities market towards the end of last year. But by and large, investors still smiled to the bank. It was a good December for those that took advantage in January or within the year. So it's really, investment really pays. Even if you look at crypto, digital assets, it was also a bull year for digital assets. So overall, we would say that there's really no excuse for anyone to say that you've not made money. So what I will always say is, don't speculate, because that's what, if you speculate, don't chase stocks. When you hear that it's when it has gained 100%, that you see everybody talking about it. That's when you go in. You may be the one holding the bag when the major are out.
So holding the bag means that everybody has bought and sold, and you have bought at a high price. Okay.
Yeah. And you keep regretting, checking your portfolio, and you keep saying it's red. You don't understand this market, how it works.
Bull trap.
Once you are already late to the party, look for the next opportunity.
All right, sir.
Or if you have to take the risk, let it be very small. Thank you.
And again, so just to go back to what you said, so in 2025 in Nigeria, if you had taken more risk, you got more money. But if you had done, even the federal government that is mostly risk-free, issuer risk-free, you also made money, because you are talking about 25% yields on T-bills and all that kind of stuff. But the guys that didn't make money were the ones that just were passive and left their money in the banks and didn't take any risk whatsoever. Is that if I could summarize that?
Yes, yeah, that's well summarized. Yes.
Okay, perfect, sir. So also last year the best performing asset was silver, then followed by gold. Then we had the foreign stock markets, Poland, 100%, South Korea, 100%, more than 100%, then Nigeria, 51%. What about guys that diversified? Was that also something that Nigerians could have done in 2025? And is this something that we should look at as part of our team now?
Yes, perfect. Because when we talk about investments, we see it from a portfolio perspective. So you need to allocate. So there was a time last year that I was asked people to buy the ETF. So even if you don't have access to the gold, GLD that tracks gold. There's new gold Nigerian exchange too that tracks gold.
New gold.
That you would have still made at least minimum of 50%. If I look at this year, minimum of 20% if you are still in gold or the silver. So you always need to craft a portfolio. Don't put, like you be used to the language of not putting all your eggs in one basket. It's not about just stocks alone. You look at fixed income, you look at alternative assets, you look at high yield investments. For the very young ones, whether 5%, you look at crypto. So you need to have that portfolio, because most times gold in the last 2 years done very well. If you check their history, I don't think they've done that superb in history, maybe last 20-30 years when you check annual return. So it's really a spectacular year. We don't know when that pullback, when there will be a correction, but when you have your portfolio is balanced, what you look at is overall return.
Gotcha.
Yes.
All right, fantastic. Let's move to the next topic, which is going to be more or less our 2026 investment outlook. What are we looking for now as an investor? So we have investors in Nigeria. What should we be looking for?
Okay, firstly, we need to look at, if we're going to do like a top-bottom analysis. One, we know that there's been a lot of very hard reforms that we saw in the last 2 years, which we feel that there's been a bit of stability going forward. So when you analyze the CBN business survey, credit survey, the confidence index, it's pointing that the economy is stabilizing, which means that there will continue to be more opportunity. So on those, before I get to those assets, you look at the year, so we expect there's projection that GDP will above 4%. There's also expectation that at least oil production would at least continue to keep very high, above the target of the 1.5 million barrels. Inflation is expected to still be low. We see a lot of whether we look at the new rebate system, we think that maybe from January, February, things, so based on the different methodology that's been used in calculating this, which should still be within the maybe 15% range. And interest rates, look at the budgets, almost 23 trillion budget deficit. It means that, which you're already seeing, that the first half of the year, interest rate will remain high. And what investors should be doing is take advantage, similar trend for last year, lock in for long-term maturities. You see treasury bills at 22% yield. Buy one if you can wait. Buy one. If you have, when you see, as we progress following month, you see FGN savings bond moving to 15, 16%, and almost 17%. Lock in at that rate for 2 years, 3 years. Because once those 10%, 11% level, I don't advise to lock in your money for 2-3 years. You will miss out of opportunities. You miss out of opportunity. So
locking where side? Is it the federal side or the private side, i.e. CPs? What's the best way for us to lock in? And I know we're going to talk about.
Yeah, thank you very much. So the first one, when we look at fixed income, when you want to lock it, you look at commercial paper, look at the long-dated ones, because whatever the issue would always reflect the current interest rate environment. Treasury bill primary markets or whether it's secondary markets, they are maturities from almost 30 days to 36 something days. So if I'm investing, I'll be doing the 364 days for funds I know I may not need for 1 year and take advantage of that above 20% rates. You also want to look at the FGN savings bond 2-3 years, invest in the longer one once interest rate is high, and once it's low, go to money market, build your capital, because money market will benefit. There's the ease of taking your money, exit and entry for money market funds.
Okay.
When interest rates are not attractive in some of these bonds that you cannot easily exit, move to money market, build your capital. When you see the opportunity, move your money, because there's return on mutual funds are not guaranteed. And I would like to state that there's a new rule that the SEC released, I think, late last year, that asset managers should begin to mark to market their mutual funds, even money market. So to break that down, to simplify that, is that if an investment outfit or asset manager had bought bonds at 90 naira, before they keep it at that 90 naira because they hardly sell in the funds. They always keep building it. There's no pressure. But now, if we have a major shock in the system, it means that a bond that is at 90, they'll be keeping the net asset value. They value that mutual fund every day based on the instrument that is within it. So when the prices of those instruments goes down, it means that the return on that investment will also be impacted. And if we have a bad year, it may also impact significantly. So the stability that we used to enjoy, I think they're giving out firms about 2 years to do that, which means that maybe about 1.5 years to go, to move from reporting it as held to maturity. So forget the terminology. Report at cost. Now they want them to be reporting it based on market prices.
Value. Gotcha.
Yes.
So, sir, will that mean that if a company has bought bonds years ago, when these bonds were even issued at a lower coupon, and now interest rates have gone up, that company will just do well simply because of its holdings? Is that what it means?
Yes,
okay.
Correct.
Okay.
They do well, but also the other way around. If there are some major instrument that you bought at very high price and market down, it will also impact on it. So over time, I think it will be gradual, not to send a major shock. But I always say it's important that that it's target return based on the rule.
Okay.
Mutual fund gives you target return, but it's also a way to accumulate and build your capital easily and to take advantage of other forms of investments.
Question for you, sir. Is it wise to buy this mutual fund at a lower NAV and then move to another mutual fund at a lower NAV to take advantage of that on capital appreciation that you think has not been captured? Is that a good strategy, or you just buy the mutual fund just to earn the returns? Do you trade them, or you just hold and wait for the coupons? What do you think, sir?
Yes, so I think that is to just buy. Moving around, because you don't understand, you don't know when they will be reclassifying and they will be repricing. So that will turn to speculation. So it will just be good because they accrue the return on those investments on a daily basis. So just buy, continue to accumulate quarterly. For most money market mutual fund, pay dividend quarterly, compound, continue to build. But once you see that you are building it and it's becoming significant, rather than putting those funds in mutual funds, you can identify the instrument directly. You see treasury bills, primary market, call your banker, call your investment firm. So you want to go for the auction 1 year, get your 21%. You know that it is what you see. That's what you get. You already know, even with tax, which we'll get to, that has been introduced for this year now on most of those short-term dated instruments. But you know that there's no fluctuation in your return, and you can predict what you get when you want to exit. Thank you.
So that's fixed income Nigerian. What about fixed income? Should we see this for the tax thing, or what about fixed income foreign? Is there an opportunity there for Nigerians?
Yeah, so I think that especially for those that have major funds, I feel there will be opportunities. When they hear that we expect that interest rates should come down, which means that the prices of those instruments will go up. The traders will understand that. So, which is positive. You lock in now, or you invest. Let me use the terminology lock in here. So you invest now when the rate looks, when prices are low and yields looks high. But as the Fed, whether it's Fed or the UK, CBN, the UK bank is also cutting rates. We begin to see that prices of those instruments will be going up. And we also expect that there will be, especially look at the US, that there will be a bit of an expansionary policy this year to ensure that to support growth, which means that there will be more money supplied to buy into those instruments. And as a result, as they are buying into those instruments, the prices of those instruments will begin to go up, which you benefit from. Look at the foreign, even mortgages. For those that can take advantage now, because rates are high, the demand is low. So it's those that are able to lock in ahead of when we begin to see when mortgage rates come down, become more attractive. And that, it's a market of demand and supply, which the market is more efficient. So if you look now, you will begin to also benefit. You also benefit from that.
Okay, let me ask you a question that we always get from our Nigerians, right? So I live in Canada, I live in America, I live in the UK. I want to borrow, carry trade. I want to borrow those currencies in their currency, pay at the lower interest rate, bring it to Nigeria, buy a fixed income in Nigeria that is going to pay me 20%. Do you think in 2026 that trade still happens? Because you can borrow, like I said, in the US now for 3 to 6%, and you are earning almost 20%. Is that going to be a trade in Nigeria going forward in 2026?
So I think it will still be possible in 2026. But as we approach election period, you may need to reduce your exposure on the carry trade.
That's Nigerian election.
But yes,
okay.
We're already preparing towards 2027 again. When you know that there are a lot of uncertainties, we'll see the foreign investors trying to pull out. So there may be a bit of pressure on the FX. So that is really very important that we need to take into consideration. But by and large, we don't expect significant depreciation of the Naira this year. The CBN will still like to will ensure that they sustain that stability we enjoyed for the last 1 year. So when you're able to get funds at 3-4% abroad and you convert it to Naira and you're able to get 20-21% yield, I think that is fine. If you're also able to hedge, maybe to protect yourself with a bit of premium, may also be better. But having those positions, I think this year will still work out. But if within your portfolio, don't let it be that all your investment is what you are converting. Still ensure that you have those foreign currency positions too in portfolio, so that on a net basis at times, it may reduce the pressure if whatever the unexpected happens. So you won't be too exposed.
Gotcha. Okay, so I think we've talked about fixed income. Have you talked about equities, or should we go to commodities now? For 2026 now.
Okay, let me speak about. I think equities is still going to be very interesting this year.
Yeah.
Where I would look at it from different sectors. So you would see that there were a bit of recapitalization. That's when look at the bank recapitalization, and so far this year the banks have not enjoyed any major rally this year. So I think that there will still be upside when we begin to see their results, because long as interest rates remain very high, new high long-term funding that they've been able to get, that would going to be very positive. The economy stabilizing means that they may be able to give more lending. And if we get this issue of credit scoring right, that they want to link to NIM, link to your PAP, and give you a rating, that is going to be a major game changer, because with your BVN, NIN, you can see all the areas where you have, and you can see your credit rating, and that will send a strong signal to even serial borrowers, defaulters rather, that don't pay back. So that would give confidence to the banks to lend more. So we should expect in the banking space. I know the pharmaceutical space, the tax benefits. So there's been major rally, and maybe most investors that missed out should wait for the pullback and position as they see that the result, because some of the tax exemption on VAT, input VAT, some of their asset classes, based on the inputs that they use, that they are being exempted. They classify pharmaceutical under essential. So that would be more money for them, which we're already seeing. Nemet, and Baker were fitting. Most of them have moved, but we, as market will do, there will always be a time for a pullback. So that will continue to be an attractive sector. The insurance sector, the recapitalization, which lapsed this year, the top banks, is not a recommendation, but you can do your additional due diligence. Look at the likes of ICO, Mansard, Mutual Benefits, Cornerstone. Those top 5 names that I've looked at them, they should be comfortably be able to meet up with, and raising additional capital means that even if you don't expand immediately, the income you earn on equity capital, because you may not pay it immediately as dividend, and it's not fixed income or debt capital that you have to pay interest on, would also be a major boost. I feel the telecommunication sector, it will continue to sustain. Data is life, like we'll say in Nigeria. People, even those that have not, maybe apart from food, that after food, everybody wants to get data. So they'll continue to earn. That space will continue to also do well. The oil and gas space, with oil production sustaining that level, we should also expect that things will continue. We continue to also do very well. Which other sector?
So let's not go to commodities. Like, just because of how well they did in 2025, the gold, the silver, the oil, is that still something we should look out for in 2026? Already, if you look at the markets now, because of the tariffs, because of the issue in Japan is blowing up, their yields are going up, people are running to safety. And so gold is still looking very, very strong. Bitcoin is falling as I speak. So is that still an investment outlet in 2026 for Nigerians?
Okay, so for me, I would say, because I've looked at one principle that always, if I've missed a train, that means when you see something that moves significantly, then jumping on it is always a 50-50. It's always difficult to predict. What advice on those, especially the commodity, gold, silver, that have moved up significantly, is that invest maybe small amounts, or invest on pullback.
Okay.
Don't jump on don't jump on a moving train.
Gotcha.
The opportunity still exists, but when we look at the last 2 years, that return, at one point there will be a correction. That is market. May not be this year, but at one point there will be a major correction in that market. So you have to, and if you have made money, don't be too greedy. Take some profit. I'm not saying sell all. That's 20%, 30%, so that paper profit is different from booking the main profit. So I think that they will, with a lot of uncertainty, political uncertainty, yeah, there will be opportunities, but I would want people to be too aggressive about it in case it have a major correction before the end of the year.
Yeah. So what I did, I don't know if I could. What I did this year was I created a new portfolio and I called it my Trump portfolio. And what I'm just doing is that anytime the market goes down, I buy. The market does 5%, I sell. It's a pure trading account. I'm going to owe a lot of taxes, but I'm trying to do an experiment to see if just buying and selling on the news alone by 2027, if I'm going to make a profit. I know it's going to be a lot of taxes short term, but I'm just trying to see what will it, because there's just so much uncertainty. So that if you buy, sell, what do you think?
I think that's very smart because we would see even this week, you would see that that there's always that opportunity for those that are able to follow the market. We saw before Trump announced that he was going to the tariff place tariff on the Europe countries, and within 24 or 48 hours reversing that. So we always see that and think that apart from the concern around tax, if you see that you are getting gains of about 5% and maybe you're able to do 10 rounds even this year alone, that's almost 50% by the time you also take. So I think that it's also really a very smart one. What one can also just look at again is what are the sectors that the Trump administration would also favor. We know for those that are within the producing war ammunitions, we would also do well this year. So the energy space with AI, all these things will be consuming energy well this year. So these are some of the areas that investors can look at. And I tell people that even if you don't want to take any risk, I try to analyze what we call VOO that tracks the top 500 companies, S&P 500. In the last 5 years, it has done an average of 15%. So, say for 2022 that was down and the return almost doubled. So for those that maybe you do on a monthly basis, which helps you to be disciplined, whether it's $5 monthly, you want to be putting there $10 monthly, $100 monthly, you would have up to average of 20% if you are consistent with that. And if you check a 50-year record, after 50 years that I try to look at, not more than 10 years that the stock market, the overall stock markets have been down. Years that precede those years are always very massive. So if you don't want to be picking or be selective about stocks, look at ETFs. There's QQQ that tracks the top 100, the EO that tracks the top 500, especially for Nigerians. So if I'm Nigerian and I'm a Nigerian rather, and I'm earning 15% return, dollar return, factoring in any Naira depreciation every year, is higher than Euro bonds, is higher than whatever I will get in any dollar placement.
Gotcha.
That's off. And you see it's not always volatile. For VOO to lose 5%, it means the likes of those top stock would have lost about 20% in a year. So that's another strategy that very conservative investors that don't have time can begin to also adopt to build portfolio. They pay dividend, you continue to grow, add that dividend to your investment.
Yeah, it's actually the VOO that I'm actually doing that strategy on, the buy and sell. I just picked the VOO. I bought last week because of the Trump thing with Greenland. It fell. I bought. This Monday again, I'm already seeing that it's going to fall because of the news on the Canadian tariffs and Japan. We'll buy again. When Trump makes peace, we'll sell again. They want to, like you said, defense. We're hearing they want to bomb Iran again. So anything defense, Raytheon, Tomahawks, F-35s, that's going to go up. We are also seeing that the U.S. wants to invest in strategic minerals. They invested in what they call in MP, anything to do with rare earths. They're also investing. So again, like you said, sir, it's just to look at where the money is going to, and then to invest there. Okay, sir. So again, just to reset the room, we were talking to Mr. Ayodeji about the investment option in 2026. We've looked at 2024 stocks, bonds, commodities. We had 4 topics. We've done 2. Once we're done, if you want to speak, you can just request to speak. We're going to just do 2 more topics now, and then you guys can come and ask your questions. It's going to be here till about, and it has less than an hour to go, so he's not going to be here for a long time. So let's go to the next topic, which is now going to be Nigeria has passed this new tax Reform Act. What does this tax reform act change how investors should look at the market, i.e. stocks, fixed income, commodities, real estate? Does it change anything? And if it does, what should we as investors be looking at, sir?
Okay, thank you very much. So tax planning and record keeping will now be very important. And record keeping will now be very important. So the first thing, when you look at the capital gain tax, which applies to equity investors or those that are acquiring assets. So, but for investment, we look at the investor. It used to be 10% flat before. This year, based on it aligns with your personal income tax rates and is capped at 25%. So, you will need to keep your records for the threshold that has been set. We know that if the total investment that you are trading with, so the way it's going to be done is that, let's say you buy 10 million worth of GT Bank, you sell it, it will keep accumulating. So it's not until you buy 150, the threshold is 150 million. So I buy 10 million today, I sell 10 million, that's 20 million. I buy 10 million tomorrow, I said that's, so if you hit that threshold, you would, whatever income you have made, you will pay tax based on your personal income tax rate, which is maximum of 25%. Or if the gains that you'll be making, you will make from that investment. So even if the total turnover I've done is 50 million, but I've made 10 million, I will pay tax on that 10 million.
Okay, so what, Mr. Ayo, again, just to make this point, just so we get this point, because we've been going back and forth on this point. So you are saying that if I just sell 10 million naira worth of a stock, 10 million naira worth of a stock, but I made a profit on that 10 million naira worth of stock, I made 11 million naira profit, you are saying that the capital gains tax would apply to me?
Correct, because I had to confirm this directly from the chairman. So when there were a lot of back and forth too. So the
wow.
Yes, so it's either or.
Can someone tweet that? Can someone just tweet that, please? Just can someone just tweet that? So because last week we were here, Mr. Ayo, and we were going back and forth on this. So if someone can just tweet that, just so we are clear, it's not just the 150. It is the profit, or it's or not and, or yes, not and. Okay.
The rule was saying and, but once you hit one of, if you, so when you look at the condition, so when you meet one of those conditions, it means that you would be liable to pay tax. So if the total turnover is 150 million and my profit is 5 million, for instance, I will pay tax on that 5 million because I've hit one of the conditions. However, even if my total, the second one, which is even if the total proceed is 10 million and my profit is above 10 million, that means I've made 100%, right? I have to, you would pay tax on that 10 million.
Gotcha.
Yes, so you pay tax on that 10 million. But what you can also do, some of the plannings that you can see is in your portfolio, for instance, if you are carrying some stocks that are on, that you are making a loss. So rather than going to pay 10 million, I may sell and crystallize some of those losses to reduce the percentage of tax that I will pay. So you don't keep just holding and selling those that are profit. So there's a need to plan it. So you do your, if you crystallize loss of 2 million, what's the tax savings that you will get from your profit? So you need to do that calculation. And most times it may be better for you to just crystallize the loss and reduce the amount of tax that you are paying. So it's really going to be very interesting time. But if you know you will not, based on the statistics, it's expected that for the retail investor, for almost 80% of them may not, or of the retail investors rather, will not hit that particular threshold. So it's only those that know that their total turnover will get there that start the planning. And also keep your records. You know how tax is done in Nigeria. They don't have the perfect record because administration is also one thing that is on top of the discussion. They can just write you that, sir, Mr. Kalu, we discovered that your tax liability is 100 million. Mr. Kalu will say, please, guys, calm down. Let me show you my record. It is not 100, it is 5. But if you don't have records, you cannot prove. You can't. You must be able to prove. So if you are selling, be keeping your records, ask for your statements promptly, especially for those that know that they will meet that threshold. So it's important that you are keeping your records yourself. And if you are a major investor, you may even want to engage for a small amount, engage a tax consultant, so that you're already planning some of these things and you're seeing the implication. So, like we always see in the developed markets, US markets, UK market, that December you see a lot of transactions going on because their tax planning is going on. People are trying to see what to sell. We'll begin to see that from this year too in Nigeria, that not just people selling to take profit, but people selling to plan their taxes.
That's called tax loss harvesting, right?
Yes, tax harvest, correct. So we also see that a lot.
Gotcha. Very interesting. I think it brings in a lot of complexity, not just a bit of sophistication out to the Nigerian market, where you see folks, like you said, selling positions that are at a loss simply because they have made a profit and they want to post for that year in a balanced income position, not to avoid taxes. Very, very interesting, sir. Very interesting. But just to go more specific, there's also something in the law that says if I buy collective schemes, it is exempt, right? But that means that the mutual funds, the ETFs, have sort of a quote-unquote advantage over individual stocks. Is that what I'm reading as well?
No, so you would see that for the mutual fund and collective investment schemes, the portfolio manager had already paid those taxes. So it will impact on the net return that you'll be getting. So you don't, because if as a portfolio manager, if I'm a portfolio manager, for instance, I buy treasury bills, government will not exempt that treasury bills from withholding tax.
Mm-hmm.
So I would have paid the withholding tax on that fund. So they know why they are doing that is to avoid double tax, because you have already paid it indirectly. I've given you 1 million. When you were using it to buy treasury bills as part of, let's say 100 people have come together, put 1 million. When they are buying treasury bills, they already paid 10% withholding tax.
Gotcha.
And all the applicable taxes would have been applied before they distribute. So the tax will still affect you indirectly. But the reason for why government is putting it that way is that there won't be double taxes. Because if they are taxing you again after you have paid tax indirectly, because what comes to you is the net yield, the net return at the end of the day. Before any distribution, you would even see that management fee of the portfolio manager would have been deducted.
Okay.
Custody, all those fees are also deducted before returns are actually paid.
So it's just to avoid that double tax where a company, an ETF, has bought a share, paid the withholding taxes, then you buy that with that ETF, you shouldn't pay the tax twice. That's what it's for.
Correct.
Okay.
Yes. For instance, that tracks the top 30 stocks. When they are buying, they are paying VAT, paying all the different taxes as transaction fees already. So they have paid it.
Okay.
It is the net that comes back to.
What about the provision where it talks about if I make income from foreign investments, so rents, dividends, coupons, and I bring them back to Nigeria through approved channels, I also don't pay tax. So I'm thinking if I buy BND, which is an ETF that tracks US Treasury bills, US bonds. So I buy the BND from Nigeria, and they pay me a dividend in Nigeria from dollars. Is the tax act saying that this dividend I get from America is not going to be taxed because it's coming back to Nigeria through approved channels? Is that what they're saying?
Yes, that's what they are saying. That this is just like a concession to encourage more FX. So that they want to see whether that would help bring in more FX.
More FX, okay.
Administration is still not clear. So I buy through, let's say, Lotus Neo by Afrinvest, Bamboo, that I'm paying to the firm. How will they also know? Because that is not coming through any official channel. So I feel that those that will affect more is those that invest on platforms in diaspora. So I think focus is the diasporans, that they don't actually invest from Nigeria. Those ones is when you are bringing your funds, repatriating them, you are coming through the CBN, coming through the banks, the original, the official channel. That is when you can be tax exempt. But they won't, if I convert my Naira to dollars, invest in stocks through a Nigerian platform.
Yeah.
I've already even put a bit of pressure on FX already. So there will be no tax advantage that I will enjoy because I got the dollar from Nigeria. That's because the platforms will source those dollars from Nigeria and pay the counterparty in the US for these shares.
All right, and just to be clear, sir, just to be clear, the capital gains tax is annual, right? So does it reset every year? If I do 150 this year, next year I go back to zero and I start again, or it's a cumulative? Just to be clear.
No, it's every year.
Every year.
And what has been introduced is that even the prices will reset every year. The clarity that the prices will reset every year, right? Because we will, if you bought GT Bank at 70 and by December it is 90, when you move to the following year and it's now 100, you won't be charged based on 70 that you bought it. It will be the 90 of that. So every end of the year, prices of stocks will really be very important because that's going to be the reference point. That will be the reference point for the taxman.
So just want to be clear. So you are saying that of course the beginning price, the ending price determines the capital gain. That's what you're saying, right? The beginning.
Yes.
Okay.
Yes.
Okay. Perfect. All right. So those are the two that I saw. The dollars coming in is tax exempt if coming in through approved channels. You don't pay tax on collective schemes and all that. What else did I see in terms of investment there that I want to bring up? I think that's really it. So let's just quickly, sir, do your portfolio, right? Your portfolio for a Nigerian that is basically earning 30-year-old Nigerian and a 60-year-old Nigerian. Based on all what you've said, based on the tax law that has been passed, a 30-year-old Nigerian wants to invest. 30-year-old is not married, he's making money, $5 million a year. How should he build out that portfolio, sir? And again, guys, after this, we're going to take your questions. So if you want to speak, just request to speak. After this question, we'll just take your questions. And so, go ahead, sir.
Okay, thanks. So, modeling the portfolio for a 30-year-old. So, I would call the one for 30-year-old like a growth portfolio, and for 60, dependability portfolio, because at that age, you are just after income. So, starting with the one which is the aggressive growth portfolio at 30, I would advise that you put 60% in equities.
Equities.
Yes, 60%. But within that equities, also have ETFs should be around 30 to 40%. To normalize the impact of volatility, stock market volatility on your portfolio, and ensure that you understand what you are buying. If you are going to, growth stocks should not be more than 30% at most. Growth stocks are they are always very volatile, but they also deliver high return over the long term if the business grows. And for fixed income, I would say you can, which will capture both, excuse me, both bonds, treasury bills. You can look at 20%.
20% fixed income.
Yeah. Talking periods when you see the high interest rate. I love what some people did last year. Bonds were trading as high as 22%. They locked in at that 22. So when bond yields came to about 16, they were not impacted.
They were in the money. Okay.
Yep, the money. Second, you also look at money market cash because you need.
Money market.
Yes, because you need emergency fund. It's for liquidity, about 10%. So you will not be.
Sorry, sir. This 20% is for bonds. The 20% earlier was for bonds.
Yes, it's for bonds. Yes, fixed income or bonds. Yeah.
Okay.
For bonds. For the money market / cash, which will be 10% emergency funds, so that you won't be forced to liquidate some of those investments if they are not in the money. Then alternative would also be important. We've spoken about crypto, maybe about 5%. And you can look at the traditional ones. If you are just by the top 2, top 3. Most times when you look for those that the traditional ones, you hardly miss it. When they are down, just buy and keep and monitor your portfolio. REITs, you look at gold, the alternative, look at gold, silver. If you have another 5% in those alternatives, you just pick them every year. So even if there's a correction, you are still buying because let's assume that you are setting aside 100K every month for savings. You know how you allocate it like that. Then that would give you, at least when you look at the return, you should have an average of about 30% every year. But coming to the one for age 60, which would be like the income preservation portfolio, 20% should be in stocks, which would be just high dividend paying stocks and blue chips. No time to take risks at that level. 50% in high yield bonds and treasury bills. You know, those instruments, those bonds are not easily tradable. You are only investing for the return and wait for maturity. So you have about 50% there. You are getting your coupon as a when due. And for the money market, you need more cash at that point. So 25% should be for that stability and your monthly drawdown. Yeah, you also need to just set aside that. Then for the alternative, if you have to do it, the gold, the real estate and stuff, maybe no more than 5%. So that should give you an average of about 22% in a year. So that if you do that, I think that you would the return on your investment will be stable. So would say that inflation, which has its potential to maybe going double digits. So standard savings account, you get 3 to 5%, means you are losing almost nearly 30% of your purchasing power annually if you are not investing. So cash is trash. So in 2020, don't try to keep cash.
No cash.
Yes.
Okay. Fantastic. So I just shared this 30-year-old portfolio. I'm sharing the 50-year portfolio. So 20% stocks, 50% bonds, 30% cash or money market near cash. And the alternative is going to be 5, 50, 60, 50, 80. Okay. I got it here. So thanks for that. So sir, let me allow folks coming. They've probably been waiting a long time. We've got about an hour or so left for you. Let's get is it Herr Fortune Dube? Dube, you're first. Go ahead, sir.
Yeah, good evening, Kalu Aja. Good evening, Mr. Ayodeji. Thank you for this space. Right. I'm quite young, right? And I want to key into the 30%, the young folks investment, right? Yeah. So I've been doing this investment, thing, right? I've been doing the whole investment stuff, and I wanted to please explain something about penny stocks, because we understand it's like a risk-reward, high-risk, high-reward kind of investments, right? And since you've been given different portfolios for age gaps and age differences, you didn't say anything about penny stocks. I understand it's volatile. It could also yield quite some return, right? And also, I looked into the real estate, REIF, real estate investment funds. I don't know of others. I see real estate investment fund as mid-risk stroke reward, right? I don't see it as high-level risk reward because, yes, in Nigeria, real estate is kind of the big thing now. Okay, so if it's a kind of it's a portfolio whereby if you go into, there is something coming out for you, but there is also reward that could mar 30% or 50% of your capital if you venture into it. But that is not. I'm just looking at the penny stocks, right? Small money, how the market treats this this stock, and how it flips the money, and everything.
All right, sir. So penny stocks.
Yeah, so really very interesting because like this year, for some of us that are fundamentalists, looking so weird, like in some of these penny stocks, those that are not even doing anything have done 100%. So why? But you must understand, I like the word you used, that high risk, high reward. It's this. We also saw that trend last year. Most of what happens there, if you are unable to monitor or you don't have the right strategy, you will get your fingers burnt. What I would advise you is to allocate. Yes, for some of those penny stocks, when you see them, also try to go to their financials and even see whether the returns. You know, when a small company is starting, there's a lot of shocks that they get. That's why we call them growth stocks. Compared to those that have stabilized, they have enough cash flow, they can withstand pressure. Even those that are strong, in periods when there are major shocks in the economy, we see what they go through. Compared when you're now relative to those that are even just coming up. So you need to still allocate. This period, it looks like the technical guys are really shining. Even stocks that, when you check their results, are not doing anything, are return 100%. But at least from my own small experience, I've almost been in this market for close to 20 years. Markets would always reward fundamentals. So don't get caught up. So what strategy you can do, if you have made money from some of the penny stocks and you check their fundamentals and you are not sure what they are doing, take some of those profits and be investing it in strong stocks to diversify. Yes, because the saving grace is that in Nigeria, maximum loss is 10%. You know, if you try any penny stock in the US, you can lose 100% in one day. Yeah. So just be careful, have your allocation on REITs. We're already seeing improvements on REITs because of real estate. So you can, that's, you know, when I was doing the allocation under alternatives, so even having 5% is not it's not a bad idea having that in REITs. So that's what I would say on that. Thank you.
Perfect. Thank you so much for that, sir. Let's hop on to Viva Essence. Viva, go ahead. Viva Essence. All right, let's get to Steven. Viva, real quick, go ahead.
Can you hear me?
Yes, I can hear you now. Go ahead.
Right. Good evening, sir.
Good
Thank
evening.
you so much for the platform. And I actually want to tell you, I really want to communicate you privately, please, regarding the investment I talked about. I wrote you online anyways. I don't know if you saw that.
Me or Ayodeji?
You yourself.
Oh, I'll send you a DM. No worries. What's the question? Yeah, go for it.
No, that's what I'm saying. It just has to do with my investment. I'm okay. I've listened a lot from.
Okay, just send me a DM. Send me a DM. Yeah, you should send me a DM. Yeah.
All right, sir. Thank you very much.
You're welcome.
All. Thanks.
Yes, sir. So we've got Mr. Steven. Steven, go ahead.
Good evening, Mr. Ayodeji. Good evening. My question borders pension funds and how folks could leverage it. You know, And this is particularly folks below 50, because those above 50 can only, be in fund 3 and above. So those below 50 basically have between fund 1 and fund 2, to play around with. And here lies my question. If you are young and maybe you still have up to 10 years to clocking 50, would you advise such folks to, reach out to their PFA and intentionally switch from fund 2 to fund 1? Because by default, you are in fund 2 if you are less than 50. Would you advise that they switch to fund 1, knowing that fund 1 is a bit weighted towards equity, and given that they still have up to 10 years to clocking 50? What would you advise people? Yeah,
I love that. I love that question. Okay. Yeah.
Yes, I think that's very, very interesting. So when you look at on Fund 3, based on the allocation, is that maximum of 20% in equities, private stocks. So I would say that yes, because even when you look at the investment profile, it's still moderately conservative. So 80% fixed income, 20% stocks. So it's not really high risk. So, and there's potential for higher return if you are lower than 50. So I would suggest that for those that if you can switch if you are still below 50, you can switch and enjoy the high return in the market and help you to compound. Yes, so I think that's because the PFAs also have criteria that they look at when they invest. Some of all this stuff that we're talking, because of their fund, they will not even touch it, and they would invest more in stocks that have strong fundamentals and also deliver significant dividend. There's a rule: if you don't pay dividend out of 3 out of 5 years, then they can invest in those stocks. So I think it's not a bad idea. That's very fantastic suggestion.
That's a bit of active passive. You are doing active passive, but you're also being active in choosing the exact funds you want your funds to be in. Not a bad one. Yeah, nice one. Let's get Eze Chikwelu. Eze, how you doing?
Hey, I'm all right, Carlos. Thank you very much.
Good to be here.
Always, what you do for us, Nigerians.
Thank you, sir.
Ms. Ayodeji, thank you for being here. First off, Ms. Ayodeji, there was a time I dropped you a DM, right? Because me and a group of my friends wanted to go straight when it comes to TBs, go straight to the market. And I know Carlo always reposts your post, and you said it here one of the times you visited, that if you have 50M and above, that you can go straight. And I sent you a DM, but I didn't get a response. Please, can you kindly look at that?
Apologies, but I can add it to your question now.
Okay, cool. So my question, I just want to re-echo this so that the people at the back like me will hear. I think it's a good news. So you said, as I was listening to you and Kano, that the price, the CGT, the capital gain tax, right? I think, Carlo, correct me if I'm wrong, there was an amendment to it that the prices will always reset every year, January. So if someone bought a stock for, let's say, 10 Naira, and the stock now ran to 30 Naira in December, as long as you did not sell, by January, it will reset to 30 Naira being your purchase price. Am I correct? That means if you sell after January, you will only pay capital gain tax from what the price was from January. Please, am I correct? That's what I came up to.
Mr. Ayo, is that a correct?
Can you repeat that again?
He said, go ahead. As I make it real sharp, so he gets it.
Okay. This is it. So if I bought a stock in December and for 10 Naira and the stock ran to 30 Naira, right? In January, the price I bought that stock will reset according to the new law that affects CGT to 30 Naira. So if I sell from January, let's say it turns to 35 Naira, and I sell it in February, my capital gain tax will be measured from January, which was $30, to when it was 35 when I sold. Is that clear?
Perfect. Yes.
That's each year. Each year.
They call it reset. It will reset.
Because where he's going to say, in America, it doesn't reset. Your basis is so if you bought a stock, the stock has a basis, and that's what baked in America. Where if your father bought a stock 20 years ago, and then your father passes away, then your base resets to the price at the date of him passing. So in Nigeria's case, it's actually good news that if it's resetting every year, we don't have that capital gains tax on our backs every year. That's what I'm hearing, sir.
Yeah.
So it's actually okay.
Perfect. That's correct.
Perfect.
Yes. Then sorry on your PMA question, but before I answer that, please, the question Mr. Stephen asked, I think I mixed it up. The Fund 3, which is 20% allocation, I think Fund 2 is about 55%. So to me, hello?
Go ahead,
Am I
sir.
correct?
Yes, go ahead, sir. Yes, I know Fund 1 is a bit more weighted than 20%, but go ahead, sir.
Yeah, so Fund 2 is about 55% maximum exposure. To me, for retirement fund, even below, I think that's really on the high side. I will not take that bet. That's individually. I'm very conservative, maybe because I'm also getting close to that. But I think that it's at 55%. It is really a lot. If I would prefer to even invest in ETS myself and monitor the performance of stock to support whatever contribution I'm making. So I think that's going to be my view on that.
Well, okay, just to follow up on Stephen's point, if you're a Nigerian and you hear that equities in the last 3 years, equities have done very, very well vis-a-vis inflation. So if you bought bonds and you went in equities, you didn't beat inflation. If you bought equities, you beat inflation and you are retiring. I think that's the point now that if I'm exposed to equities, I have a better chance as a Nigerian to beat it. Yeah. So I think that's a very important point. That's why I like this question a lot. Okay, sir. Yeah. Let's get to 360. My good friend, 360.
Sorry.
Go ahead, sir. Sorry if I cut you.
The last question for Mr. Ezekiel.
Sorry. Go ahead.
Yeah, so to invest for PMA, just contact either your bank or your investment. Once you send them your rate that you want to go at. When you check the rates, there's what we call the stop rate. You have to check that stop rate and look at the yield that you're comfortable with. The last stop rate was around 18.37, for instance. We give you a yield of above 21%. Yes, so you can go directly, contact your bank, fill the form, send them an email, and they will confirm to you after the auction. Thank you.
Gotcha. So let's get 360. So again, just a quick one. So as a Nigerian, just to be clear, a Nigerian in Nigeria, can I do this direct T-bills or it's only for foreigners? Just to clarify that, sir, if you don't mind.
Yeah. So there are two types of bills. There's the primary market treasury bills. There's the OMO, what we call the open market operation that CBN issues directly only to banks and foreign investors.
Okay.
But for the primary market treasury bills auction, is available to everyone.
Okay.
That has 50 million, whether you're in diaspora, your money, but you can't invest in dollars. You have to convert your money to naira before you can invest in that.
So I knew there was one that was only for foreigners. Okay, perfect. Let's do 360 GDpreneur. How are you doing, sir?
I'm good, Mr. Carlo. Good evening to you.
Good evening to you, sir.
Thank you. Just a quick question, though. I think I learned one or two things from what Ezekiel was saying earlier about the price of stock resetting every year. I think it's a really good one for us in Nigeria. Yeah. My question is now, given the fact that we're just looking at the investment options for 2026, and me understanding that Nigerian stocks actually did very, very well, in last year and even early this year. I have this question, like, if you are to be me right now, and you are considering the Nigerian stock market and cryptocurrencies, given the trends and all of that, which do you think would be a best bet for me as an investor, maybe looking at Nigerian stocks to invest on and comparing that with the entirety of cryptocurrencies and the best crypto assets to actually invest? Which do you think would give me better results or better yields at the end of the year 2026? That's just the question.
Okay, if I get clearly between stocks and cryptocurrency, right?
Wow.
Is that what you are saying?
Yeah, Nigerian stocks and the currencies. Yeah.
First of all, we must understand the level differs.
Yeah.
The volatility differs. Also, the company that you are also investing in also differ. I would say that the Nigerian stock will give you more stable return. For the cryptocurrency, it's highly unpredictable, right? If anybody is trying to just guess it, if you are not looking at long terms, because 1 year is too short to predict crypto, you have to look at long term for that. So for me, based on my understanding, I also have a little bit of investment in crypto, so it's not like I'm totally out of it. But I would say that the Nigerian stock market will still deliver, for this year, should deliver, I'll use the word should, not will, better return, because stability in the economy, if our FS remains stable, when we begin to see more FPIs coming, prices will also move up. And we're also beginning to get more awareness amongst retail investors that are creating activities in the market. So look at the combination of that and companies delivering more positive results. We should be able to deliver more than cryptocurrency at the end of the year. Yeah.
So, sir, is that because of that cryptos are going down or because Nigerian stocks are going up?
No, because as at that period, for crypto can be unpredictable. You know, that December now, it might go up 50% middle of June, and by end of December, it's also it's down. It's so unpredictable. A lot of factors.
Yeah.
So if we're looking long term, we know that BTC may still get to $200,000, right? With all the top investment banks also buying Ethereum and Co. But trying to project crypto over 12 months, a lot of things always happen if you check history.
Gotcha.
Yeah.
Gotcha. Great question, sir. Let's get Ben. Ben, hi. Mr. Ayo has about 15 minutes in with us, so let's try and get his folks on deck to speak. Ben, how you doing, Ben? Ben Awoks, ready? Let's go to...
Yeah, I'm here.
Yeah, Ben, go ahead, please.
Good evening.
Hi, good evening, sir.
Yeah, good evening to the guests. I just have 2 questions. The first question is more like a general one for people. For people who have, a substantial level of liquidity and they are looking to invest specifically in Nigeria, and they don't have necessarily the time to start looking at balance sheets and the P&Ls, monitoring what's going on NGX, or going to bid for, what do they call it? All those fixed income securities. What do you think about, basically I'm saying, what do you think about mutual funds, ETFs, specifically for people who don't necessarily have the time to study, what's going on in the market and buy those individual stocks and bonds themselves?
Okay, yeah, thanks. And I think I like this question especially for those that are just coming to the market. ETFs are avenues that help investors, and they also deliver fantastic returns. So when you check those that invested in ETF 30, that's the NGX last year, minimum, if you invest in January, you should have close to at least 40% as at December. Market did 51. For some, maybe close to 50%, depending on the NAV that you came in. And look at the US ETFs, S&P 500 returned close to about 22% last year alone. It's done close to about 7 or 8% this year. So you would see that there are real opportunities. So you don't need to understand a lot about the market. And you will not also be going through the different major volatilities that you always see in the market. So that's really very, very good areas. You can even look at it by sector. I started looking at quantum computing, and my mind, I couldn't start investing directly in those stocks. Said, okay, let me ETF that will track quantum. So I leave that to the portfolio manager, because they would have used different criteria to classify and identify those ones they want to be investing in. And the return has been really very good. It won't be as much as one or two of those stocks within. So for gold, GLD, for instance, just you look at that, and you can just be assured that that someone has done their homework before coming up with those index, because most times the ETF tracks the indices, different indices, and they've always been delivering. If not, most of those ETFs will be dead if they are not performing at all.
Okay.
What about mutual funds? What do you think about mutual funds?
Yes, mutual fund is also very, very good. But as the volume of your investment begins to increase, you may need to get a bit of knowledge, or maybe even get your portfolio manager that you engage with and tells you how to, let's look at treasury bills, let's look at bonds. We'll go to the market on your behalf and get the bonds in your portfolio. You can use a custodian to help you, to help ring-fence it within for you. So once you begin to build, but for a start, mutual funds is always very good. As low as 1,000, you build your investment, and maybe you are getting to 50 million, and may begin to consider going directly than getting into the pool.
Okay.
All right.
My final question is
Ben, just
what do you think about what the SEC did?
Real quick, because we have he's leaving about 15 minutes, and we have those guys. So real quick, sir. Go ahead, sir. Real quick.
I've asked the question. I asked about the SEC. What does he think about the recent SEC changes to the requirements for capital market operators?
I'm a market participant, and please, I like to pass, and I hold a lot of positions. So there are different unions that have spoken. EFMAN has spoken, Ashon has spoken. Different organizations have also spoken. So the man under authority. So let me pass.
I understand.
Thank you.
All right, sir. Yeah. Perfect. Let's get Peter.
Carlo, please. I know this is out of place for you, but please, can I chip in something about this?
No. Hold on. Let's just get Peter, Usofio, then Viking, because it's leaving in 15 minutes, and these folks have been waiting. I'm so sorry.
No, it has to do with the ETF in Nigeria. Just clarification, so that he
real quick. I want to keep pull. Yeah, real quick.
Okay, Mr. Ayodeji, in the US, when you want to buy ETF, you consider net asset value decay, you consider actively and passively managed, and you also consider expense ratio. Does this apply in Nigeria?
Of course.
Hello?
Yeah, the answer is of course, yes. But Mr. Ayodeji can ask, it's asking if we consider expense ratios and NAVs and all that when we buy ETFs.
Yes.
Yeah, the same.
You can compare, use that to compare that because the percentage of the return, the expense will also vary across different asset managers. There's a cap by SEC, right? That the maximum you can charge. So it's also good to confirm that.
Yeah. I mean, if you want to invest in ETFs, go to a big firm with low expense ratio. They are just buying the same thing. VOO, QQQ is the same thing they are buying. Look at the expense ratio, make sure they are big, and then you are good to go. Let's get Peter, then we'll get Osifo, then we'll get YK. Peter, go ahead.
Okay, thank you, Mr. Carly, and thank you, Mr. Ayodeji. Thank you for all you're doing. We are really learning a lot.
Peter, your audio is kind of muffled. Your audio. Can you fix that real quick?
I hope you can get me now.
Go ahead.
Is it better?
Go ahead. Yes, it's perfect now.
Okay. So still on the ETF and I think equity mutual fund. So I want to ask Mr. Ayodeji. So assuming you have 10 million and your focus is on this diversification asset, how can you allocate your resources? Thank you.
On the diversification, ETFs and sorry, I didn't get that.
Peter, what are you asking? Sorry, can you say it again, please, Peter, real quick?
I'm just asking, like, in terms of which one is more advantageous, looking at historical return, which one is better managed, equity mutual fund or ETF?
Oh, I think you are mixing it up, Peter. You can have an equity ETF. ETF is the basket. You can put shares or bonds in that basket. So yes. you're sort of asking your question is kind of juggled up. If you don't have the time and you want to diversify and you want an expert manager, you put money in an ETF. Now that ETF can buy bonds, it can buy stocks, it can buy a combination of both as a balanced ETF for you. So it's based on what you want to do. As a Nigerian, if you want to buy a US stock, you don't have money to buy everything. So buy the ETF that buys the whole US market, either equities, VOO, or BND, which is going to be bonds. That's the point he's making. Peter, does that make sense, Peter? All right, let's get to Osifo. John Osifo, hi.
Yeah, thank you guys for your contribution and insight. Kalu, thank you for organizing. Ayodeji, thank you for everything that you're offering. It's very knowledgeable and we are learning from you. My question is regarding the volatility coming to election in Nigeria, which is, Tinubu and the Atiku. What do you think about the currency? Are we expecting any devaluation in currency if we were to send money and come and invest in Nigeria? And at the same time, do you have any timeline for Dangote refinery listing?
Two powerful questions, Mr. Ayo.
So first, I'll start from Dangote refinery. Based on their discussions and stuff, maybe latest second quarter. But there's most of those things are always kept until they get all the approvals before they want to disclose. And it can keep moving depending on how the approval process is. But we are sure that to 2026, that will be economic. Please, your first question again.
He's asking for if there's going to be devaluation of the naira anytime soon.
The currency last year.
Okay, the currency.
Nigeria dealt with us. It dealt with any money that somebody put in an investment last year. Where you have 700 from 700 to Olegonos. If you have any investment, you kind of loses the value.
That was in 2023 now.
Hold up. Okay, John, let me answer the question. Ayo is asking about. He's asking about if there's going to be any devaluation soon. If you send devaluation in the.
Are we expecting the dollar to be 4,000 this year because of the election?
No, okay. I don't. No.
Right.
Because
the naira, yeah.
When you check. I was at an event yesterday that even Mr. Bismarck Rani was talking about the different methodology he has used. Our naira is currently rightly priced. What we used to have before is that we don't adjust when we're supposed to. But we're seeing that there's a bit of market forces, there's liquidity, the B-match market is providing transparency. So we don't expect any major shock. I believe that if there's serious pressure, we would see it reflect immediately even from the official market. So that will not necessitate any major adjustment because market will see that natural adjustment in the market. And secondly, I don't see any. I don't foresee personally looking at maybe maximum of 5-10% devaluation if it will happen. It shouldn't be. So at 10% at 1.5, that's almost getting to 1.7, 1.8. So, and that's why you still feel that investing in Nigerian assets at 20% may still be better.
And sir, Mr. Ayo, just to make this point again to gentlemen asking, so by second quarter, Donald Trump will have taken over the U.S. Fed. Either the current guy would have gone and Trump would appoint a new chairman, or he would have removed the Tina lady and put someone else there. If that happens, Trump has said he wants to reduce interest rates in America. So assuming he reduced interest in America, remember he's already pushing for 10% credit cards down. Good.
Yeah.
If interest rates in America fall, what happens to the dollar? It will fall. What happens to Naira? Naira will go up because more Americans will simply do this carry trade. So if look at what's happening in the US clearly, and look at then the effect in Nigeria, I don't see the dollar becoming stronger. Trump wants a weaker dollar because it allows him to do more exports and all that, and also to balance. So that helps the Naira in that because there is lower returns on the dollar, you can make more returns on the dollar in Nigeria. Nigeria has dollar bonds paying 8-9%. Nigeria has euro bonds paying 7-8%. So the same dollar in America will earn you less than the same dollar in Nigeria. So if you just factor that in, all things being equal, of course, that tells you that we might not see this huge fall. If dollar is strong, Nigeria suffers. If dollar is weak, Nigeria enjoys. And because again, we sell crude oil. So again, just to keep that point. Okay, let's get. I think we have last YK. Got Oni Olayinka Sam 3. Go ahead, sir. YK. We've got about 4 minutes. Sorry, guy, I'm rushing here.
Okay. Good evening, everyone.
How you doing, sir?
Thanks for the session. So my question is regarding pension, most especially the voluntary contribution. Recently, I engaged in a conversation with one of my colleagues, and it was like this new tax era, if you are paying directly from your pay directly to the voluntary contribution, that you're already having a higher gain because the effective tax rates for my pay grade is around 18%. So we're like, okay, if you're having 18% save on these your voluntary contribution rather than letting it to be taxed, and you still be investing in the mutual fund that is giving you maybe 60%. So what is your take on that? Thank you.
So if I get the question correctly, is that if you increase your voluntary contribution, you can save tax. Can it be up to 18%? Mr. Carlo, I don't know if you can help me rephrase. I'm trying to understand.
No, the 18% is the statutory, which is 8% from you, 10% from your company. So 18% statutory. But if you do additional voluntary contribution, you are reducing your income, which then reduces your taxable income. Because when you do ABC, you've reduced your taxable income. That's the whole idea. Yes, sir. And remember, you can take ABC out after 5 years. So look at it this way. If you want to send your daughter to school abroad, you can do ABC when she's born. And then after 10 years, you can withdraw that ABC before you retire, tax exempt. Just keep that in mind. I know that answers your question, YK. YK, does that answer?
Yes, thank you.
Oh, perfect. Last person, sir, Mr. Ayo. Last person is going to be Oxley Tech, and then we'll just last person. Oxley Tech, can you do your question real quick, if you don't mind? Oxley Tech. Oxley going once, Oxley going twice. Mr. Ayo, I can't thank you enough for coming in to talk to us. I think you've given a lot of clarity. My DMs just show the level of insight you've given us today. Lots of people want the recording after the session. Yes, it will be recorded on podcast. We are also still on the YouTube. So both the YouTube and the podcast will be recorded for you to go back and watch. And of course, also on Twitter, it's going to be recorded. So if you do have questions, Ayodeji has a very, very open Twitter page. Ask him questions. I will share his tweets about the bond market. Also, if you have a question for him, you can send to me and also send to him. I just want to thank you guys all for tuning in today. It's been a pleasure. I hope I'll see you guys next week again when we talk around education and using your tax to pay foreign education. We're going to do that topic. Mr. Ayo, do you have any closing words, sir?
Okay, thank you very much. And my closing words, parting words would be that for 2026, you should just ensure that you don't leave any idle funds. It's really very important. Don't keep any idle funds in 2026. We so expect that there's still a lot of opportunities. Nigeria has gone through the worst, and I would say at least with the last 2-3 years, there should be time that we should be able to reward ourselves. So please take investment serious, try to learn and invest. And overall, you will thank yourself, thank your future for taking those steps. Thank you so much, Mr. Kalu, for always this great opportunity. Thanks for all you do for us. I appreciate you, sir.
Thank you. Thank you for coming, sir, again. I really appreciate that, Asha. So again, guys, thanks a lot. We all want to learn. This is the time of the year where we learn about investment so we can then take advantage going forward. You know, like Mr. Ayo has said, just try to be very, very simple about this. If you don't know what to do, try to buy a managed fund. You can buy equity managed funds. You can buy fixed income managed funds. You can put that money in, and an expert will essentially manage that money for you. Look at it this way. If you are in Nigeria and you want to do what Mr. Ayo has said, there are lots of apps that are registered by SEC. There's Bamboo, there's Shaka, there's Cowrywise, which have I not mentioned. They are registered in Nigeria. You can take your Naira, invest in Naira, buy those apps, and you are diversified. I think it was 2 weeks ago, I gave you guys the V strategy, where I said if you want to buy equities, you don't know what you are doing, just look at the V. V is Vanguard. If you do VT, if you just Google VT, that's going to be an ETF where you are buying all the stocks, quote unquote, that are good in the world, right? So you are buying your Samsung, you are buying your Nvidia, you are buying your Alibaba, you are buying Mercedes, you are buying all those stocks that are quote unquote that VT has sort of collated into one ETF. So you buy $25 ETF, whether it's fractional shares, you're getting exposure to VT. Now, what if you now want to buy just America? You don't want to buy the whole world, or you bought the whole world, now you want to go and buy the largest market in the whole world, which is America. You can buy VTI, and VTI is going to give you exposure to about 4,500 American stocks. VTI. So you're buying your Microsoft, your Tesla, your Nvidia, your Bank of America just by buying that one ETF. But then what if you don't want 4,500, you want to buy something smaller? You can then go buy VOO, and VOO is going to give you exposure to American stocks, but only 500 of those four. So it's up 4,500, you're getting about 500 in VOO. But what if you say, okay, I don't even want to buy American stocks, I want to buy just stocks outside America, but not the whole VT. You can buy VXUX, which is the VX, ex-US minus the US. So you're buying your Samsungs, your Toyota, your GlaxoSmithKline, Beecher, but you're not buying American stock. That's VXUS. And it goes on. You can buy VEA if you want to just or buy if you want to just do real estate. You can buy VYMA if you're just looking to buy stocks that will pay you a dividend. So just go to Vanguard, right? Google their ETFs, and you can do a buffet. I want to get equities, or I want to get dividends. I want to get property across the world. We used to have Nigerian ETFs. It's now sadly gone, but you can sort of mirror Nigerian ETFs. You can create your own. If you look at the Nigerian market, you see IBTC 30, you see Meristrem, you see even just when I was here, his company also has an ETF. Just look at the components of that ETF and just copy it and just design your own if you want to do that. But it's a good way for you to diversify with just one investment. And again, like he said, this year going forward, we now have tax harvesting, we now have capital gains. We didn't have it before. So the normal way you bought stocks in the past has got to change, because if you buy a stock now and you heard him say if you sell that stock, even though you're not selling 150 million, if you make 11 million naira profit, you're going to pay tax on that. So when you are buying and selling, record keeping and strategy now becomes very, very important because you've got to take advantage of that. So Oxley, I don't know if you had your question. Mr. Ayu has gone. If anyone has a question, Mr. Ayu has gone. We can take that question, or we can just thank you guys for hanging on with us. I will hope to see you guys here again next week. Next week, we're going to have some guys. We want to talk around education and how we can use the tax policy, investing, and trust to fund education. That's what I want to do next week, because it's going to be very, very enriching. So that way we sort of open our minds to this idea of using trust and tax benefits towards funding something. It's not all bad. It's some many things here are good. It's not all bad. I would just say keep records. Nigerians don't keep records. Try to keep records. We would say track your expenses. The best way to keep records is to use just your debit card for transactions. If you don't use cash and you do all your transactions on your debit card. Oxley, go ahead.
My apologies. I was in transit when you called me up. So,
okay.
So the question I have is, I was listening to when someone made a submission or asked a question around the pension funds, Fund 1, Fund 2, and Fund 3. We actually know each of those categories of funds, what they are for. However, as an RSA holder in Nigeria, do you have any what's the word now? Do you have any authority, or can you decide which funds you should be? I think is it not something that you leave in the discretion of the PFA, and also there is also a regulation allowing the income regulation to say if you are, I'm thinking. My question is, do you have a say on which fund you should be on, or
yes.
Is it not something
no.
Your PFA can best decide where to make maximum use of your money and give it the best return?
No, you can.
Probably based on their risk appetite.
No. You can decide what fund you want to be in. What the PFA has done is the PFA has said that we have 4 funds, and those 4 funds are as you get older. It's like a target age fund, but they have 4 separate funds. So when you come into the PFA system, as you are younger, the first fund is more exposed to equities because that's going to give you more return, right? But it carries more risk. So as you are younger, you're supposed to be in stage 1. But as you get older, they have a retiree fund and they have fund 3. So the gentleman was asking, can he decide to say, listen, I'm supposed to be in fund 3, but I want you guys to take me to fund 1 because I want to have more exposure to equities, which would make me more money. The point Messiah was saying was that you can do that, but remember, you are now exposing yourself to more risk. As you are retiring, you are supposed to be slowing down on the amount of risks you take. What if the whole stock market crashes tomorrow? Your RSA is going to crash, but you're about to retire. So you've got to balance the rewards and the risks. I wouldn't advise that if you are retiring, you put bulk of your funds in fund 1. I wouldn't advise that. You have to have a balance. You can't, as Mr. Buffett to say, you can't impregnate 9 women and have a child in 1 month. It doesn't work that way. So the thing is, start to invest early so that it can compound and you can move naturally from fund 1 to the retiree fund. I don't advise, it's a good strategy if you can take the risk, but it's not advisable to just take all your money and take a lot of risk because you want to make a return. You are exposing yourself to a lot of risk. You can do it. You can do it, but be aware of the risks. If you want to take the risks, it's your right. Yeah.
Yes. So, Carlo, why that question is important is for people that have a pension RSA account, retirement savings account in Nigeria, you would know that your PFA maybe every quarter sends a performance report on those funds. So you will see the RSAs that are, in terms of returns, that are topping each of the funds. Fund 1, maybe you see Stanbic. Fund 2, you will see farm pensions or what is the other one? So for an RSA, if I belong to a particular RSA, and I, for example, hypothetically, I'm on Fund 2, and if my RSA is getting the best response on Fund 2, why should I bother? Because I'm seeing that when the fund performance report comes out, we can see which RFA which PFA is optimizing each of the funds. So that decision should actually be left with the fund manager.
No. Just understand what we're saying, right? When you are in Fund 1, you have a larger exposure to equities, and it's across all PFAs. It's not one PFA. All the PFAs would have a Fund 1 that has a higher allocation to equity. So the question I think it was Stephen was asking was, can I, as an older person, tell my PFA that, listen, yes, I know I'm going to retire, but I want you guys to put my money in Fund 1 because I want to be exposed to equities. The idea being I want to make more return. The answer is you can. But again, we are caveating that answer by saying that when you do that, you are exposing yourself to more risk. The 51% that the stock market did last year came on the back of a higher volatility. If you look at the Sharpe ratio and all that, it's higher for stocks than for bonds. So it's left to the individual. There's no, in investing, there's no right or wrong as an investor. If an individual says, I want to take the risk, all you can do is to advise. You can't say, don't. If you ask me, if you came to me and you said, I want to do it, I will tell you, be very careful because you are exposing yourself to the diminution of principal. If you want to go ahead and do it, it's your money. So the answer is yes, you can, but be careful, Oxley. That's really the answer. Yeah. Ben wants to have, Ben, you have a follow-up? Ben, did you have a follow-up on this?
Yes. On the PFAs and their Fund 1 and all that. I think in Fund 1, they are allowed in Fund 1 to push their let me describe it as non-fixed income investments. That's investing in asset classes that are not fixed income. Which, if you understand what this means, it means that the risk level will be a little bit higher. So they may do stocks, they may do bonds. So they may do stocks, they may do other asset classes that are not fixed income related. They can push up to 75% of Fund 1 to those asset classes. But I'll tell you this for a fact: they don't even get close to that 75%. In the last 5 to 7 years. PFAs have not beaten inflation. They've not even been able to have a year where they delivered up to 30%. That's generally their total AUM. So they've been very, very cautious. And it's not just because they are scared. It's also because of the way the investment landscape in Nigeria was, and there was a reluctance to channel pension funds outside the country. There was a heavy reluctance to do that, and it makes sense because most countries don't take their pension funds outside their country, because the pension fund is the backbone of investments in every properly working country. It's supposed to be how you fund things within your country. So there's right now there's pressure on them to collaborate with a lot of multilaterals, to collaborate with a lot of other fund managers and all that, to find a way to deploy that capital in environments that the government will aid them to make the risk very minimal. So if there is a big infra deal that involves the government and private entities, there's a big infrastructure deal, they can deploy it to however they want to do, maybe want to do by private equity or directly, they can deploy it to that deal for people to make money. So those are the type of avenues that they are currently looking at to be able to at least deliver 35%. It's very bad that your pension funds, the total AUM of pension funds is going to about 27 trillion. It's very bad that they've not been able to get to at least 30-35%. It means that as you're planning to retire and you're waiting for your retirement money to come, if they continue at this rate, by the time your retirement money come, inflation would have made it look not big at all to you. It would be disappointing by the time you see it. So this is something that they're currently working on, because there's a lot of, like I said, there's a lot of agitation to do more. They have to do more as PFAs.
I also think that the issue with the PFAs is that they cannot just invest in anything. Like, if they have to invest in only companies that are paid dividends 3 out of 5 years, So if you go to the Nigerian stock market, how many their PFAs have their own index?
Exactly. Even on the stock, they are limited to on the stock
so
exchange.
and it's there for a reason, because nobody wants to lose money. If I tell a pensioner I'm going to buy stocks for you, at least I should say at least you're getting a dividend. So it's safety first. You know where we're coming from? We're coming from a situation whereby pensioners used to sleep on the streets in Lagos because they couldn't get their pension. So now the government does not want to take any chance with pensioners' monies. It's better they give you back your principal than they owe you that principal. And I think for now they have 4 funds, Abi. Good. Before they only had 1 fund. You can only get that 1 return. Now they have 4 returns. Maybe they will have a 5th return, maybe going forward. That will say, wow, if you're a young guy, you want to do crypto, you want to buy stocks, you can go to this 1 fund. And that would then allow people in America, you can buy gold with your IRA. You can do whatever you like with your investment. But if your investment crashes, you can't run to the government. So perhaps Nigeria would, as we develop, maybe we'll look at that. But for now, I think it's return on principal, and it's a tax-free savings for you. So if you have an RSA, you're able to put money away without it being taxed. You're able to compound without paying fees. So I would say, I tell people, look at this whole tax regime. The one place you can make maximum tax savings is in your RSA. I don't see tax savings in your life insurance. I don't see it even in rent. Rent is $500,000 a year. Where you can really make an impact is to put more money into your additional voluntary contribution. Imagine if you are putting $1 million in a year into that ABC. That's $5 million in a year. You can take that money out. If you plan properly, if you know what you're doing, you want to jackpot or you're going to retire in 15 years, start today to plan to put money in that ABC, because you know you're going to take the money out in 5 years. But if you wait, you can't just put money today and take it out tomorrow. They'll tax you. So long-term planning, talk to your advisor. This money I have, I want to jackpot or I want to retire in 10 years. What should I do? Your RSA has got to be in the picture. You just can't leave it to chance and say, oh, when we get there, we'll sort it out. That's just the way you want to look at it. Yeah. Fantastic. So, guys, I think we'll just call it today. Thank you so much for being here. Real quick, I think Jesse, do you have a question real quick before I shut down? Jesse going once, Jesse going twice. All right, guys,